Welcome to CrushTheStreet.com's weekly market wrap-up. Let's begin in the equity sector, where the last session's euphoria over a finalized fiscal cliff deal came to an abrupt and disappointing end. Ironically, a major catalyst for the deflation of investors' hopes was the Federal Reserve, because some officials are increasingly concerned about the potential risks of the U.S. Central Bank's asset purchases on financial markets, even if they look set to continue an open-ended stimulus program for now. This is according to a Yahoo Finance article, and it makes no sense whatsoever. Any type of negotiation on the fiscal cliff necessarily involves kicking the proverbial can down the road, and this is by default inflationary. However, we always have to remember that it doesn't matter what is, only what is perceived to be. And if the markets believe, for whatever crazy reason, that the Fed will stop their stimulus programs, then you will see short-term volatility. But this is exactly why we have the Fed, supposedly, to prevent such volatility, and therefore, we continue to go on a self-fulfilling prophecy of open-ended stimulus programs. The Fed's abrupt moment of fiscal celibacy is an example of a fundamental driver that came out of nowhere and blindsided the markets, leading to short-term technical volatility. This was most evident in the US dollar, which was teetering towards the 78 level but suddenly shot up to close at 80.38. The rally was a technical victory for the paper bulls as it moved the index above the 50-day moving average, but there is a major overhead resistance level threatening to cut off further gains, which also coincides with the 200 DMA. Yes, we could see the dollar move past this resistance, but I look at the sessions prior to the one on Wednesday, where the price action has been pensive and hesitant. Little baby steps here and there until the Fed came in with their whopper of a story. Until the dollar clears the 200 DMA, I don't really see much life in this artificial rally, but in the meantime, there will be short-term consequences, especially for the precious metals sector. I'm not going to beat around the bush. You've probably woken up to a really crappy morning in the COMEX, as gold and especially silver is taking a mighty hammering in the overseas session. There are two ways to approach this sector. First, the metals are going nowhere fast, but they also haven't fallen off the face of the earth, which may suggest that this bull run has a lot of legs left in it. That's the good news. But the second part is that, at least for the immediate time frame, this sector is a technical market. If you're amongst the physical-only crowd, a technical market is going to drive you nuts because you're going to have to wait a long time to realize significant profits. The cost to you will not just be the purchasing price of the physical bullion, but also the opportunity cost of holding up your money and thus rendering you unable to take advantage of other financial prospects. Looking at the technicals, we know that spot silver is barely hanging on to a rising level of support at $30. There is also a resistance line running parallel to it that currently caps out at around $31.80. Recent price action has shown that silver is extremely resilient in not going underneath $29, so we basically have a trading range of 6 to 8%. The way that the non-silver stacker will play this market is to buy like crazy on dips below 30 and then sell at 32. The market will likely reflect this through the technical price action, and there's nothing you or I can do about it unless your name is Eric Sprott. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.